everyone who's joined. Thank you so much. My name is Emma Summers. I am the Director of Business Development here at Vector. Just a little bit about who we are at Vector. We are a premier fund admin focused on closed-ended alternative investment vehicles. So essentially, we do all the back office support for venture capital, private equity, fund of funds, digital assets, real estate, private debt, any type of closed-ended fund. I'm really excited to have Danielle Darley and Matt Higginbotham here with me from Weaver. We have a really cool topic that we're talking about today. It's a hot topic of valuations. We work with Danielle and Matt on a ton of our clients, so couldn't think of a better partner to have on here and have the opportunity to ask some of these really cool questions. Just some logistics. We'll be spending 45 minutes chatting through questions that we have. These are some questions that we've kind of put together from things that we get typically from maybe clients or people in the industry that we've been seeing. And then we'll take about 15 minutes at the end to go through questions that you might have in the audience. So please go ahead and throw your questions in. On the bottom right-hand corner of the screen, there's a little questions tab, and you can go in there and ask anything you want, and then we'll kind of address those towards the end of the session. Danielle, Matt, it'd be great if you can introduce yourselves, tell us a little bit about Weaver, and then we can kick things off.
Sure. So I'm Danielle Darley, and I'm an audit partner in Weaver's investment fund group. I'm based out of LA, as is Matt. Matt is a senior manager on our team, and we work together quite a bit. And we focus primarily on closed-end funds, venture capital, and private equity. So we thought this would be a great topic to discuss, as we have been getting lots of questions from our clients this year about how to approach valuation. So we want to help everybody be prepared for that, for the audits this year.
Yeah, we were just talking about before this that the end of the year is coming up so fast. I feel like we did some stuff last year around audit together, and now it's like already here again, which is terrifying.
Yes.
But we're definitely excited to talk about this topic because we haven't spoken about valuations before with you guys. We did a lot around kind of audit prep last year. So I think this is a really cool topic. I'm going to learn a ton, just given I don't know a lot about the valuation side of things. So definitely excited to jump in. I guess we can start things off with something very general. So I guess generally speaking, can you explain what a valuation is? Tell us a little bit about how the role of a valuation plays in the audit, and we can go from there.
Yeah, so the valuation is a really key piece of the audit. All investment funds will follow ASC 946, which is the specialized accounting standards for investment companies. And that standard requires that all of the assets and liabilities on the balance sheet be marked to fair value. And so when you think about what sits on the balance sheet of an investment fund, it's going to be primarily the investments themselves. It's going to make up the majority of the balance sheet. And so the gap around fair value is dictated by ASC 820, which is the fair value standard. And so any investment fund must mark their investments to fair value at the end of the year if they are following GAAP. And so with that in mind, there is also something called the AICPA guide for valuation of venture capital and private equity portfolio companies. And that guide shares a lot of information that is more detailed about specifically how to apply ASC 820 to the valuations of venture capital investments, and specifically addresses how to think about early stage investments. So a lot of the discussion that we're going to share, our insights around today, are based in what that guide suggests you should do when you think about valuing your investments. And just generally speaking, most venture capital funds typically use last round of financing to value their investments, which is fine. That hasn't changed. But what has changed this year is we have a more volatile market this year. And so, in the case where you have a more volatile market, if you were to look at what the guidance says as it relates to early stage investments, that is one of the considerations that you should think about when considering if last round of financing is still the correct price, has there been a significant change in the market? And so I think everybody who is working on audits this, all auditors and all people who are involved in managing funds and being responsible for coming up with valuations should really, take that to heart and think about the fact that they're probably going to have more scrutiny from their auditors, you're probably going to get more questions around the valuations than you've gotten in the past. So it's really important to think about this before you determine the values. It's going to definitely slow down the audit process if you haven't considered the change in the market and what that might mean for your portfolio.
Awesome. Yeah. And you kind of touched on this already, but you mentioned the volatile market that we have at the moment. So how can fund managers adapt and think about their valuation strategies in a market that is characterized by these high interest rates, inflation, all of that?
Yeah, I mean, the best way that they could do that is really just keeping that market in mind when they make their marks. Anecdotally, we've seen last round of financings happen in June or July of a given year, and the market's changed 10, 15% by the time year end rolls around. Well, you now need to analyze whether that last round is really what the market would support for evaluation there. And it's not necessarily to say that there should be a change. It needs to be considered. It's another factor that needs to be considered. And, with interest rates being so high and seemingly maintaining that high rates and inflation staying high, a lot of companies are trying to spread their fundraising out. They're trying to make every dollar last as long as they can, which begs the question of, is that round that happened maybe a year, 18 months, past, is that really what the company's worth? Have they done, really well? And maybe the company's worth more. Maybe the company's not doing as well. Costs might be changing, inputs might be changing, their strategy might be changing. Things are just so volatile that, managers should really just be stopping and really considering, is the investment that they made really what's still happening and still what the market would view that as.
Mm-hmm. Yeah. So I guess the last question or the next question I was going to be is, how do fund managers analyze companies to determine if the last round of financing is still reasonable, which you kind of mentioned already, kind of thinking about, the time frame as things changed, all of that. But I don't know if there's anything on that side, Danielle, you wanted to expand on too.
Yeah, I mean, so, as Matt mentioned, the last round of financing is a great indicator of the value of company. But again, if there have been significant changes at your company itself, has what's happened at the company? Are they hitting their milestones? Are they not hitting their milestones? Have they, has anything significant happened at the company that might mean that last round of financing is no longer the best indicator of value? And then also what's happening in the market itself is an important consideration, because while your last round of financing might have been at a certain valuation, if overall the industry that you're operating in, if maybe comparable companies have seen lower valuation rounds, that could indicate that at least you need to consider perhaps that your value may have declined as well. Or on the opposite, it is a fair value standard. So it's not just should the value be marked down, it could also be your value should be marked up. But the basic thing is that you want to go through a specific set of, a thought process around certain questions that you would want to ask yourself. And I think starting with essentially, how is the subject company itself performing? Does it have sufficient cash for operations? You would generally want to see that you have enough cash for operations through the end of 2024. So I think from the perspective of, the auditors that you're working with, if the company no longer has enough cash to operate for the next year, that might be potentially an indication of impairment. And that's one example. And then secondly, what did the company promise at the time that you made your investment? What the fair value standard is meant to do is for you to, what it says is for early stage companies, you may use the last round of financing as a point of, you're calibrating back to that valuation. And so you're always going to be considering what has changed since the time you made that investment. So something that could have changed is they're hitting it out of the ballpark. They well above their milestones that they promised at the time of making the investment. They've achieved their goals much quicker than possible. That might indicate that maybe there needs to be a markup in the investment, but you might be, then you go to the next thing that you want to consider and say, how has the market itself changed? Maybe the market itself in your industry has seen lower valuations, and maybe comparable companies have had rounds of financing and those have been at lower valuations. And so that might offset the fact that your company is doing really well. And in that case, you might conclude that the last round of financing still makes sense, because for my subject company, I went through and thought about it. And first, they have enough cash. They don't actually need to go out and fundraise. They've got plenty of cash for the next 12 months through the end of 2024. And then also they are doing really well. They're actually beating their milestones. They're doing better than what we expected. But then when I look at what has changed in the market or the industry that I operate in, there's been a decline. So you take all those factors together in that example, that might be an example where you could say the last round of financing still makes sense, because I have kind of a positive, an indicator that maybe I'm doing better. And then I have a market indicator that the market's down, and those might offset each other. So it's really kind of going through and thinking about each investment and what has happened specifically. If you think through those three questions, what's happened with that investment? Do I need to consider a change? And you may be able to conclude that, the last round of financing still makes sense, but you can expect that your auditors are going to ask those questions. So you want to have thought about them before they ask.
Yeah. So Danielle, you mentioned the word impairment. And so what are some indicators of impairment in portfolio companies? How can they be identified? What do people normally look at?
Yeah. So, it really is a few things. So first, do they have enough cash for operations? So, if they only have 6 months of runway, that's probably a good indication that there might be some impairment, because what that means is that, they're going to run out of cash in 6 months, right? So they are going to have to fundraise in the next 6 months. So then your next question would be, well, what is the market that they're operating in looking at like? And in general, we have seen a downturn in almost all industries in the market. So in that scenario, you don't have enough cash, there's a downturn in the industry that you are operating in, that might be a potential indication of impairment. Another indication of impairment is the failure of the business to perform to plan. So similar, and a lot of times these will go hand in hand. They burnt through their cash quicker than they were expected to, and they also haven't been meeting their revenue goals, say, not performing to plan. So those two together would probably also be an indication of impairment, or even just one of those on their own could be an indication of impairment. Then the last is a downturn in the market in which the company operates. So this could be, the way you could kind of consider this is, what are we seeing in valuations of transactions of other private companies in the same industry? Like, do you know of a competitor that just had a down round? If you do, then that's probably a consideration or a potential indication of impairment. Have you seen a downturn in the multiples of comparable public companies? And if so, that might also be a significant indication of impairment. And then another way you could look at it is if there's an index that applies to your industry, have you seen a downturn in that? So those three areas are where you would, if you go through and ask those questions and think about all of those areas, that might lead you to conclude I have impairment. Or you might go through and say none of these are issues, which is a good reason to keep it at the last round of financing.
Yeah, that makes a lot of sense. Also, and then so actually the next question that we have is really interesting, because I get this question a lot too. And I'm sure you guys do as well. In the absence of information rights, what methods can be used to estimate the fair value of a company?
Yeah, this can be real challenging. This is probably the most difficult valuation consideration. All the information we've really talked about getting understandings of the company, finding out, if they have cash, all that stuff comes through conversations with your portfolio companies. If you don't have access to that information, it's really challenging to figure out whether or not, there's a markup or a markdown that's needed. Some of the things that we look at is, there are public information that you can use to analyze. Sometimes these companies will make announcements about, on a good end, they made a major milestone, or they got, approval from the government on something, or, something happens that they make an announcement. That's a good indicator that the company's doing well. Otherwise, you can see things like we see announcements of layoffs. That's not as great. So maybe that's an indicator. Trying to just see what's out there, see what the competitors are doing, like Danielle said. Anybody's announced that there's rounds, or there's some positive in the market. That's all in the information you're trying to pull together. Something else a lot of our fund managers do is they'll ask for specific information that's not as sensitive. They'll go in and be like, hey, I know I don't have rights to the full financials, but can you tell me how the company is doing overall? Can you tell me what high level revenue numbers are? Can you tell me, are you meeting your expectations? Are you meeting your trends? Have you had a new round of financing? Some of those kind of broad questions, it's not going to give you a full detailed analysis, but it'll at least give you indicators of what that company's doing. And that can sometimes, lead to good results of, I have enough information to know this company's either doing well enough that I can hold it steady, or, maybe not make a full markup, but it's not needing to be marked down or impaired or anything like that. Another thing that companies can do is just kind of see, like Danielle mentioned, see what the market's doing. If you look at, a tech ETF and see how the tech ETF is changing, and you're comparing that to a portfolio company that's in the tech industry, that'll kind of give you an idea of if that industry is really tanking and they're down by 20, 30, 40%, then you might need to be taking a haircut on your investment value. You might be needing to write that down. You might be wanting to look at comparable companies, precedent transactions, any information that's out there in the public that you can use to just get an understanding of what's happening in the market, what's happening with this company, what's happening with competitors, to come up with an estimate of fair value. It's important to remember that these fair value estimates, they're estimates. We don't know. If we all had crystal balls, it'd be great. But the reality is that you're just trying to do the best that you can with the information that you have available, and make sure that it's a reasonable mark based on that information.
Yeah. There's so many moving pieces. I feel like I always know valuations. People always say it's like an art. It's an art creating a valuation or doing evaluations, but there's so many pieces to it. It's kind of crazy.
Yeah. And that's for sure true. It is, I would say, more art than science. And, I think the biggest message that I think we would like to relay here is that you definitely don't want to just default to last round of financing without some consideration of what is going on. Like Matt mentioned, one thing you can expect is that the auditors are probably going to go through and like Google the company, for example. So hopefully you've done that too. And you are aware of any big announcements and things. If you do not have information rights, you aren't required to just make up information in order to change the valuation or determine what your valuation should be. But if the information is publicly available, it's like you should know about it. So I definitely have run into situations where when, our audit teams go through and do their testing, which one of those is just to Google the company, and we see, the company had massive layoffs or, these kinds of things. But there's been no adjustment to the fair value. It's certainly going to lead for us to have to ask questions about that. Yeah. So, if you can be ahead of it, you're just going to have a smoother audit and know what is going on with your company.
Yeah. And what kind of, I guess, to spin off of that, like what kind of timing should fund managers be doing? Like, when the audit time comes around, you're doing evaluations year end, like, are you supposed to be looking at these companies over the course of a few months? Do you do like one check towards the end, or what do you typically see, when fund managers do the research?
Yeah. I think, some managers are, keeping up, are really looking at this on a, I guess, continuous basis. They're getting updates from their portfolio companies and they're tracking those. And I think that's probably definitely the best practice. But I also recognize that, especially for emerging managers, there's limited bandwidth and the ability to be able to do that. So, from the purposes of an audit, what we're going to be concerned with is what are the balances at the end of the year. The date on which we're performing the audit is going to be most important to us. So if you don't already have a regular process in place to reach out for updates to your portfolio companies, I definitely think now is a great time to do that. And one suggestion is, working with your audit team to find out which of the investments that you hold are going to be significant to them for purposes of the audit. And you might be able to combine their need to confirm the investment with your reach out to the portfolio companies and essentially, copy them on those communications. And that way you have to spend less time bothering the portfolio company because you've combined that reach out. And then that helps you because, you can find it out in December how the company's doing and what's going on. And that still gives you time to adjust your fair value for the year end. And you've already knocked out the confirmation process with your auditor. So I would highly recommend that if you haven't already had that discussion with your audit team, like consider that, letting them tell you which investments do they want to confirm and using that confirmation process as also a reach out for an update on how the company's doing.
That's a really good tip. I think too, I think one reason that our teams work so well together is because we try to get ahead of a lot of the things that we can before the actual audit time comes along. So I think that's a really great tip, just to, any way you can get ahead of the audit process and start doing those now, definitely a good thing. So we've talked a lot about the market and how that affects valuations. Do you have any specific, or any examples of significant changes in the market or the economy that could impact the valuation of investments?
Yeah. So, one example that comes to mind for me is, in the last year, just between Q2 2022 to Q2 2023, if you look at fintech, that we've seen the number of funding rounds for fintech companies has decreased like 50% year over year. So that's definitely an indication that there might be a downturn in that market. Also, you look into that further, and if you look at public fintech stocks, they've decreased in value over 50% in that same time period. So that's definitely an industry that if that's in your portfolio, I would watch out for that. So any kind of significant decline, whether it's in private transactions or public markets, those are some examples. Some other examples could be, what if you have a company in a geographic location that perhaps, like with the war in Ukraine and now the war between Israel and Palestine, do you have a company that operates in that area, and are they going to be impacted by what's going on there? That's another example of something that's happening in the global environment that might have an impact on your portfolio company.
Mm-hmm. Matt, anything to add on to that?
No, I mean, just kind of being aware of what's going on with, the geopolitical environment is also something too. I mean, the past administration put certain tariffs on, and if that's going to affect inputs, that could change things. And, it's not necessarily going to give you a direct number of, okay, this company is now worth 10% less, but it's going to give you an idea that, hey, something happened here. And, should we consider this as an impact to our fair value?
Mm-hmm. Yeah. So I guess we keep talking about the things that can impact changes and what, the market can impact it, all these different components, but how do you actually estimate the adjustments to the fair value when there are indications of change?
Again, it can kind of be hard because those indications don't give you a specific number. What we typically see, and one of the better ways that we've seen do this, is using public companies, using guideline companies that are similar to your industry, similar to your company's operations, seeing how those have changed over the year. Just kind of saying, okay, hey, we see in the broader market there's a 20% decrease. Maybe a 20% decrease is warranted. We'll apply some adjustments to that. The subject company might be growing faster, and so maybe they would trend a little bit higher. So maybe you do a 15% decrease or something like that. Really those judgments are going to be based off of these specific circumstances of the company. But just trying to use those in the information in the public that you can get to as a reasonable estimation. And again, can't reiterate enough, these are just inputs to the overall analysis. They're just, you're coming up with some type of metric that tells you that something should happen, and trying to come up with what exactly is happening is really difficult. But using the experiences that you had, using your knowledge of the market, using, your knowledge of the companies, you can come up with something that's reasonable. And I would say from an audit perspective, the best thing that you can do is have all those considerations and all those judgments documented. The auditors will want to know, hey, how did you come up with a 20% discount, 25% discount to your last round of financing, if that's what you do. And just having that information readily available so that we can look at that, verify it, understand your thought process, understand your reasonings, will kind of help make that process smoother.
Yeah. So you mentioned a lot touching on the publicly available information, utilizing that. Are there any other ways that you can use that information effectively in the fair value of a company, or is that kind of everything that you've been already discussing?
Yeah, it's kind of everything we've been discussing. I mean, the public information, there's a lot of information. I mean, if you're looking at the fintech world, there's tons of information and studies out there. There's ETFs, there's specific indices, there's public companies, proxy companies. There's all these different metrics that you can use. And like I said, these are all just inputs to that overall analysis. It's not, the entire picture. And it's not to say that the last round of financing isn't a valid mark. It's just, again, if you had a recent round of financing 6 months ago, everything is going steady. The company seems to be performing well. The last round of financing might not be a bad mark, and that might be reasonable. It's just we want to consider that, hey, if there's all these other changes in the market or we don't have information rights, does this give us indication that maybe this company is not worth as much? And then using that information as best you can to come up with a fair value mark. And it can be changes in trading multiples, changes in price, changes in the indexes, just any changes that you have can be used to come up with some type of estimation of fair value.
Mm-hmm. So when you do go to compare your company to another comparable company and do the analysis, is there like a specific process that fund managers should be going through, and how does that work?
So typically what we'll see is, the most common is essentially what's called a comparable company analysis. And what you're doing there is finding companies that are comparable to your company. And you could do that either through looking at public company comps that are in the industry and you think are comparable to your company. Or you could also look at private transaction comps that are, again, similar to your company and your industry. In both cases, you would want to think about, like, what would a company like mine, what would it typically trade on? Like, when the valuations are considered, are they usually based on a multiple of revenue, or is it on a multiple of EBITDA? We typically see, revenue more commonly with early stage companies because, typically an early stage company is not yet profitable. And so probably the metric will have to be revenue. And so what you would then be doing is saying, okay, if I look at a public company comp set, for example, and that public company comp set is, just to use a simple example, trading last year, or really at the time I made my investment is really what you're looking to calibrate back to. They were trading at a multiple of 10 times revenue. Now they're trading at a multiple of 8 times revenue. So that's a 20% decrease. Then that might justify a 20% decrease on your company's valuation. You will always want to consider, how are you different? I mean, you probably aren't comparable to a public company. Generally, like an early stage company is not going to be really, there may not even really be public comps that make a lot of sense. So you could make adjustments then, based on the size of your company compared to the public company, or perhaps your potential for growth. Maybe those public companies' growth rate's been very flat, but you've had exponential growth. So that's something that you might consider adjusting when you're doing this analysis. So, as we said before, it's a lot more art than science, and you do want to always be thinking about, how am I different than whoever it is I'm trying to compare to? Because if I'm using someone else's multiple to determine a value for myself, I do need to think about how different I am from that company. Mm-hmm. And again, it might just be sort of an indicator, because if you were to apply the multiple and maybe the value's only changed 5% since the time that you made your investment, that might be just good support to say, hey, I should just leave this at last round of financing. It's pretty close. We aren't seeing a significant change. So that a lot of what you're doing might be just sort of looking at these public, looking at the public comps or looking at private transaction comps, applying them to the metrics of your own company and seeing, does that give me a significantly different answer than the value that I already have recorded, which is, the last round of financing price. And I might be able to just use that as a way to prove that, I do not need an adjustment to the value. But if you get an answer that is significantly different, that's when it's time to start thinking about the differences between yourself and the public company, and perhaps that plays into the adjustment that you make.
Mm-hmm. So when should proxy companies be used, and what are the limitations in valuations?
I would say proxy companies are best used when you probably have a feeling or you're aware of some changes in the market, but you just haven't quantified it. Now you can go in and look at these and say, okay, I made these investments during the year at this point in time. Now we're looking at what the comparable information is, at year end, and now it gives me a quantifiable number. Or maybe I made investments last year and we did a fair value analysis at year end, and so we're just seeing what the changes year over year. That's really the best case of those, and it's just trying to quantify something that either you've just seen in your own operating experience, or you're just feeling in the market, or whatever it might be. Some of the limitations, though, like Danielle said, there's size limitations. There's whether or not there's actually comparable companies, how comparable those companies are, where they are. There is a lot of question marks in terms of how comparable the companies are, but it does give a pretty good indication of how the market's changing. and going back to the beginning when we talk about high inflation and, high interest rates, the market is going to be different. And so as those changes happen, it's hard to know how different, and using these proxy companies as an understanding of, hey, this is a close estimation of what the market's changed with, just seeing how they've traded, how they've changed. It's a good indication of what's happening.
Mm-hmm. Yeah, that makes sense. So how can scenario adjustments be applied to fair value estimation, and what scenarios should be considered?
So, scenario adjustments are a really good way to, I think about the valuations. And so what is a scenario adjustment? Essentially what you're doing is laying out what are the scenarios that I expect to happen. So for example, one scenario might be, I expect that this company is going to remain at the value, the next round of financing, it will be raised at the same value as the last round of financing. I think based on everything that's happening, it's essentially still worth the same. That's one scenario. Maybe then the other scenario is that you are seeing a significant downturn in the industry. So you think, there might be a possibility that actually I'm going to have to fundraise at a lower valuation. And that's the second scenario. And then maybe your third scenario is, well, the company is kind of short on cash. They maybe only have 11 months of runway at the end of 2023. And so there is some risk that this company isn't even going to make it until the next round of financing. So those three scenarios, and in the case that you think they're not going to make it to the next round of financing, then I guess the answer might be that you're going to get nothing or some very minimal amount if the company were to run out of cash and liquidate. So you would consider what you would get in all three of those scenarios and assign a probability to each one. And this kind of allows you to kind of bring in a little bit more art, as we were saying, and think about what are the possible things that can happen? What do I think is most likely? And then blend those values together to determine what your value should be.
Hmm. Yeah, it kind of goes back. We were talking before about valuation policies. This is just making it sound even way more complicated on how to put together a valuation policy. So what considerations are important when assessing the quality and growth potential of a portfolio company, I guess, relative to its peers?
So I would say, what is the historical performance of the company? Have they typically had a much higher growth rate compared to their peers, or have they been struggling to keep up with their peers? That could go either way. How have they performed against their milestones? Have they been beating their milestones every year, or have they been struggling to meet those milestones? I think those, really those two are going to tell you, what is their growth potential? Has anything specific happened at the company? Like, they've restructured or they've gotten rid of a specific line of business that was dragging them down. And then that's going to help them focus more on their core business and therefore potentially grow much faster in that area. Have they entered into a strategic partnership with another company that's going to have a big impact on their growth potential? So all of these things could, really help you assess what the growth potential is of your company. And a lot of times we see that the companies are providing, quarterly or monthly updates that do discuss a lot of these things, like high level, what is the company doing? So I think reading those updates is really important, and assessing how that impacts your company and what they're going to be able to do in the future.
Yeah, I guess spinning off of that, a lot of funds will collect KPIs from portfolio companies on a regular basis. Are there any kind of specific ones that you think are very important to collect from companies when going through this process, or what do you see on that side?
I would definitely say, KPIs on revenue, on cash burn rate, on, depending on what the industry is, there may be a lot of other really specific KPIs. Maybe if it is some sort of software platform, or, users that you have, and as you're growing the brand. So it really is going to be industry specific. And I think it's like, what would managers at that specific company, what are they focused on? And so your KPI is going to be different depending on the type of company that you have. So if you have a really diverse portfolio, you are going to really need to think about how are the founders of the company or management of the company, what are they thinking about? What are they reporting to you? And that's probably a good starting place for what's the best KPI.
Yeah.
Yeah. One of the main ones that we see too is annual recurring revenue, especially with the early stage tech. some of these companies are growing so fast and they get these major contracts that they want to factor into their valuations. That's not necessarily going to get picked up in financials. That's not necessarily going to get picked up in, historical growth rates. That's going to be a future looking thing. So getting information on recurring revenue is a really important metric that we look at.
Yeah. So can you provide any insights into fair value estimations for note investments?
So, generally what we typically see with note investments is that those are going to be held at par. So, the principal value of the note. Though, however, there are some reasons why that might not make sense. So is there substantial doubt about that company's ability to continue operating? So kind of going back to what's their cash burn rate and how much cash do they still have on hand? If they have very minimal cash and you don't think that they have enough cash for operations for the next year, then how likely is it that they will actually be able to repay your loan? That's what you're, thinking about there. And if you think there is a likelihood, whether, depending on how significant that likelihood is that they will not be able to pay you back, you would need to factor that in and potentially impair that loan. And so this is a really good time where I think using like a scenario analysis could be helpful on notes, is because you could kind of say scenario one is they raise another round of financing and I'm able to convert my debt into shares, and I basically get my principal back in that scenario. And then maybe the other scenario is that the company goes bankrupt and they aren't able to raise another round of financing. And so in that case, maybe the value to me is minimal or zero. And then you could weight those two with a probability.
Mm-hmm.
So that's important to think about. And the other thing with notes is you also want to think about if they are interest paying notes and you've been accruing interest, if you do think there is a likelihood that you will not be able to collect on the note, you also should not be accruing interest anymore. And you may need to write off previously accrued interest that is no longer collectible.
Okay, interesting. So just for the audience, because we're running up on the last couple of questions we have here, just a reminder, go ahead and throw your questions in. It's in the bottom right-hand corner of the screen. So if you have any questions, now's your time to ask. So we'll go through a couple of those. And then also too, I'll send out Matt and Danielle's contacts. So if you ever want to reach out personally after the fact or chat through some more specific things, you can absolutely do that too. So how should fund managers approach down rounds and calculate preferences when valuing their investments?
So this is kind of a new thing that we've been seeing in the market. The past couple of years, most companies were growing, doing well, raising financing. Now that we're seeing some turmoil, we are seeing quite a few more down rounds. When you have companies that are doing well and everything is kind of up and up, the assumption is those companies are doing well enough that basically everybody will convert to common. Everything's going to be pari passu. You write everything up to the last round of financing. But when you start having down rounds, now the preferences are really going to start playing into the factor. Earlier investors might have, they might have a preference that's higher than what the latest round is, indicating a down round. And so rather than converting to common, those investors would probably just take their preference. It's going to be more economical for them to just get their money back than taking a haircut. And so what managers really should be doing is trying to get the cap tables from the portfolio companies, trying to understand what the value is. The value is typically, based off of that last round of financing. The overall, enterprise value or equity value is probably going to be reasonable if they had a recent round. And then just calculating what the preference would be. The articles of incorporation will typically tell you what the waterfall provisions are going to be, what each round's preferences are. Calculating an analysis of, is it likely that these companies are going to convert to common or each preferred series is going to convert to common or not. And if you have shares that are going to take a preference, there's a good chance that the earlier series or the common series is going to get diluted a little bit. So you'll see, where that value is going to be in the waterfall will be kind of skewed a little bit. So, really what they should be approaching is saying, hey, if I have a series B and they just raise a series D and it's a down round, is it still likely that if this company were to liquidate today, I would still convert to common to share in the upside? Or would it be more economical for me to just get my money back if it's a 1x preference or, whatever that preference might be?
So you talked a little bit about this when we just talked about down rounds, but can you share some of the trends over the last, I guess, years on valuations, kind of what you've been seeing across the board, and any trends are always interesting?
Yeah, I mean, what I've seen is it's kind of all over the place. There's not really a clear market. Some industries have been hit really hard. Some industries are doing okay. Some of them are doing well. It just kind of is all over the place. We have seen quite a few more down rounds, and the bigger thing that I've seen is just the time frame between when the rounds are happening is being really extended. A lot of the fund managers we work with are extending their fundraising periods. It's just kind of everything is being drawn out because the cost of money today is more expensive than it was a couple of years ago. It's not anticipated to stay like this forever. At least we hope it doesn't. And so they're trying to spread out whatever cash they do have for as long as possible, which begs the question of, hey, you had this round 18 months ago. Is it still valid? Has the market changed? Is it still valid? You had a down round, which lowers the value. Would those previous investors still get their money back? What's that looking at? Down rounds might question whether or not convertible notes are collectible. There's all these different factors that play into it. But overall, the trend that I've been seeing with a lot of my clients is just things are kind of all over the place. We don't really know what's happening. There's a lot more volatility, a lot more question marks, and as inflation stays high, a lot of people are suggesting that there's going to be a recession coming. We've been hearing that for years. And so who knows when that's going to actually hit, and what happens then is kind of up in the air.
Yeah. And how does that affect you as the audit team? So given there's so much volatility and it's a lot crazier now to kind of go through the process, how does that affect the actual audit with you guys?
Yeah, I mean, I think that does put a lot more pressure on the auditors. So I think and that kind of going back to why we wanted to have this discussion and help our clients prepare is that I think that everybody can expect that there's going to be more questions from the auditors because there's more pressure on the auditors given that while we haven't consistently seen, down rounds in every industry, we have seen more down rounds this year than we've seen in the past. And so that certainly is a trend towards there being more of a downtown than what we had certainly saw in 2021 and 2022, where everything was just, up. So that is going to, and then I guess uncertainty and volatility in the market is going to lead to auditors having to ask more questions and do more work around supporting the conclusion that the last round of financing makes more sense. Mm-hmm. And so I think you can expect to see more scrutiny from your auditors, more questions, and it's good to be prepared for that.
Yeah. And with that being the case, do you have any advice on what fund managers should be collecting throughout the year, what they should be holding on to for the audit, what type of supporting documents, really what should a fund manager be preparing for this time?
Yeah. And so, kind of going back to what we've talked about is if you're getting regular updates from your portfolio companies, definitely having a good organizational system where you've maintained those and you aren't going to necessarily need to share all of that with the auditor. But if you've gone through and based some of your analysis on information from those updates, the auditor may ask you for support for some of the inputs to your valuation analysis. And so holding on to those and having that readily available. If you have had any rounds of financing, just making sure that you do have the documents from those rounds of financing. So the share purchase agreement and also the updated articles of incorporation. That's a really common one that we'll see managers not have or have trouble getting a hold of as part of the audit. So anytime you've had a round of financing, the auditor is going to need that because as we mentioned, if you are saying that you're going to mark your position to the last round of financing, that is only really acceptable in the case that that all of the provisions of the articles are essentially pari passu, that there's equal voting rights and there's equal sharing, or the conversion rate is pari passu. It's not preferable to the new series, because if the round of financing, if you're marking your Series A to a round of financing indicated by Series B, but Series B has preferences that are superior to you, that may indicate that your position should not be worth what the Series B is. And so you need to have those articles to prove, no, everything is pari passu, which is generally what we see. I'd say 90% of the rounds we see, everything is pari passu, but you're going to need to provide those articles to the auditor so that they can prove that out.
Yeah, to have a good filing system.
Yeah. I mean, it's really just a basic, it sounds really simple, but having a good organizational system where you have all of those documents and also making sure that those are executed documents. That's another thing we see very commonly is the share purchase agreements that you have are like draft, and for an auditor to rely on it, it needs to be executed.
Yeah. And then too, as a fund admin, we'll be requiring those executed documents too when we're facilitating the investment process. So I guess that's one thing to touch on too is during the audit process, when you are going through valuations, that is a big role of the GP, whereas a lot of the other side of the audit is with the fund admin. So I guess, can you explain a little bit about the difference between the GP's role with valuations during the audit process versus like what the fund manager gets involved in, or fund admin, excuse me?
Yeah, I mean, I would typically see that the actual valuations are the responsibility of the GP. And, I think that is sometimes I've seen with some emerging managers, that's a common mistake that they'll assume that, oh, well, my TPA is taking care of that. And that's not the case. I mean, the TPA will be asking you to hopefully to provide the valuation updates at the end of the year. But if they don't ask, then you need to still provide them. You do need to go through this process as the manager and determine what should the marks look like, and then provide those marks to your TPA so that they can adjust the books accordingly.
Mm-hmm.
So you want to make sure that you have a good communication process with your TPA to make sure that those adjustments do get made, because while not common, I have seen that where clients have actually done a good analysis of what the fair value should be, but there's been a disconnect between them and the TPA, and the values actually haven't been marked to what that valuation analysis is. And I would also say that you should always just kind of maybe keep your own spreadsheet of what you think each value should be, and then doing a check of what the TPA gives you in the ending package, and making sure that everything was recorded as you expected, because if it wasn't, then it's still going to be an issue in your audit. And when you have audit adjustments, it slows down the process and can also increase the cost of an audit. So you definitely want to avoid that pain. It's going to make it more painful. It's going to make it more costly. So just make sure you do check the TPA's work, because anyone can make mistakes, and you'll want to make sure you've thought about that. Another thing is, you can always also consider, if all of this has made your head hurt and you're unsure how you would really approach these valuations, you could also consider like a third-party valuation specialist. I noticed we had kind of a question around that, and I would say that the benefit to that is, especially if you're looking at your material investments, that might be really, maybe you had a investment that had a big up round in 2021 or early 2022. And so you have some concerns about if that's still valid. So the more material the position, the more important it's going to be as part of the audit. And it might be worth, getting some assistance, especially if you do have like in this question, if you have a minority position where you do not have information rights, that valuation specialist, they work with lots of different companies, and they may be able to have more insights based on the other companies that they work with. They have the data sources, some of the things we've talked about where you need to get public comp information, all of that. A third-party specialist would have all of that information. And so it might make sense if you feel like this will be a struggle for you, you don't have the bandwidth to consider using a third party.
Mm-hmm.
Yeah, I'd also add into that too, like if you're getting to a company that's getting to the later stages, maybe it's not in the Series A, Series B, we're starting to get into, Series D, E, it might be a good time to start looking at doing other valuation approaches than last round of financing, and third-party specialists are going to be incredibly helpful. So anytime you start getting to that later stage, the AICPA guidance and the 820 guidance doesn't always push you to doing last round of financing in those cases. They want you to do more of a market analysis or discounted cash flow or something like that. Those third-party specialists that's what they do. And so they'll be able to consider all those different factors and make sure that you're meeting, the 820 guidelines.
Mm-hmm. So for emerging managers, do you guys have any tips or tricks or advice on putting together a valuation policy for someone who's never done it before? There's so many moving pieces. It's quite terrifying.
Actually, Emma, I actually have an article that I've authored about like how to consider putting together a valuation policy. So I could probably share a link to that afterwards. But in general, there are the AICPA valuation guide actually has laid out like the specific things that you should be considering when you put together a policy. And so that would probably be helpful when you're thinking about that. But the biggest thing on a valuation policy is making sure that it accurately represents what you intend to do. And so, you can write a really great valuation policy, but if you don't follow it, that's going to be a problem. Or if you write a policy that is too complex, or, that's going to also cause you issues because it'll be difficult for you to actually implement that policy. And it is really going to be very dependent on the type of investments you have and what stage they're at. Like, as Matt mentioned, the valuation guide does basically say that you can use last round of financing for early stage companies that are in a position where no other method is feasible. So essentially what that means is you can't do a comparable company analysis because the company is pre-revenue. So there's really no way to do that. But if you are into Series A, Series B, and so on, and you have significant recurring revenues, you really probably should be looking more at a comparable company method. And so it would probably be good for your valuation policy to address what types of investments do I have, or am I only an early stage investor? And so everything is pre-seed, that kind of thing. And, then I would address that. What will I do though, as my portfolio seasons and comes into later stage, to where my policy might be different for my early stage investments than my policy is for my later stage investments. So you would want your policy to kind of be forward thinking about what's going to happen in the future. However, I would say also that you can also update your policy every year. So if you feel a need to change your policy because of maybe the nature of your investments changing, such as them seasoning over time, then that might be then the third, fourth, fifth year of your fund life. You need to change your policy and say, okay, now I am going to implement a comparable company analysis for my later stage investment. So it should be tailored to your portfolio and what type of investments you have.
So can my valuation policy say that I do not change the valuation of a company unless they have a financing round?
I would say no, because you could say that in your policy, but then you would have a policy that is not in accordance with GAAP. And so I do actually get that kind of, I've definitely heard that from many managers. They'll say, well, it's my policy to do this. And it's like, well, that's great. But if as auditors, we're trying to provide an opinion that says your financial statements are in accordance with GAAP. And GAAP has to follow ASC 820 fair value guidance, which really doesn't say that you can just leave things at the last round of financing indefinitely. It specifically says you can use the last round of financing for early stage investments after considering all of these factors and whether those would cause a need to an adjustment to that last round of financing. So you can't really just, create a policy, and because you have a policy that's not in accordance with GAAP, you can follow that. That's definitely going to cause you a problem.
Yeah. Yeah.
If you're going to have a policy that's like that, I would probably add in some of the considerations that Danielle and I have talked about. Generally speaking, we leave it at last round of financing, but we're going to evaluate if there's significant market changes. We're going to evaluate if there's significant changes in the company, just kind of factoring in the evaluation there. But just as like a, unless something major has happened, something significant is happening, we're going to use the last round of financing. Probably isn't unreasonable.
Yeah. And I definitely think, Danielle, if you could send me that link to the article, I'll share that one after. I think that would be a really great one to have too. Any more questions that you have, throw them in, because we'll wrap it up in a second if we don't have any more. I just saw another one come through. So how to value SPV investments, especially when the SPV K1s are not available until September of the following year when the fund's year-end audit is done in March? That's a good question.
So SPV investments, if those audits are done in March, if those underlying SPVs are audited, then using the underlying, NAV is a good way to value those investments. If those underlying SPVs are not audited, usually what the auditors will do is kind of like a mini audit of the balance sheet of those underlying SPVs. We'll take a look and get support for cash. We'll take a look at investments. We'll look at the equity balances. Try to understand how much of the value at the underlying SPV will flow up to the fund that we're auditing. The K1s aren't typically on a fair value basis. So the K1s, they have some insight into, what's on the balance sheet, but they're not fair value, because fair value marks unrealized is not a taxable event generally. And so it's not always the case, but I would definitely say, those underlying SPVs providing books, getting an understanding of what those underlying SPVs, valuation policies are and how they're valuing the investments is going to be helpful. And then especially if those underlying SPVs are audited, that's even better, because now a CPA firm has already looked at it and kind of put their stamp on it.
Yeah, and I would also just add to that, because I've seen a lot of managers that kind of get themselves into a problematic situation when investing in SPVs, because at the time of investment, there wasn't clarity around what information is the manager, is this a SPV managed by someone else? And if so, then what's their commitment to you to provide you information? Like, they may be able to provide you how are they valuing that underlying investment at year end? And that's the ideal scenario, is that they would share that valuation with you. If not, what information will they be willing to provide you? Mm-hmm. So you probably want to think about that before you go into making that investment, because it can cause you additional cost as part of your audit. Because as Matt mentioned, if that SPV doesn't have an audit itself done, and that SPV manager hasn't done any kind of analysis around what the fair value of the investments held by the SPV are, then you're going to be required to do that. So it's going to add to you time and or cost. So it's just good to address those up front before you make the investment.
Mm-hmm. So I think we have time for a couple more. How do you deal with angel list valuations? This one person has invested in a few SPVs on angel list, but angel list does not follow GAAP.
Yeah. So again, like you would have, you can't just say, well, I have this investment and through angel list and they're not following GAAP, so I'm not going to follow GAAP. You can't really do that. So you'd have to think through what public information is available. And so at least doing a search on, and again, it'd be what investments are, significant to your portfolio, identifying which ones those are. And, you might be able to do your own search and see, do you see any rounds of financing for that company? Do you see any negative news about that company that might require an adjustment to the valuation that perhaps angel list has not considered? So, you as the manager of your fund are still going to have that responsibility. And so again, it's kind of, you don't have to make up information, but you would need to be considering what public information is out there, and at least having done a cursory search to make sure there's no indication of a change in value.
Yeah. Great. I think that's probably all that we have time for. I guess, any last words before I kind of wrap things up?
No, and thanks for putting this together, Emma. We hope this was helpful to everybody that attended. And if you do have any specific questions, you can always reach out to Matt or myself. We're happy to talk through these. I think my biggest word of advice is, if you're unsure, reach out to your auditor and early, and try to get an answer that you guys can agree on before you record your marks, because it's always easier on the front end to work it out. And I think it's better for both you and your auditor if you do that.
Yeah, definitely.
Yeah, I would echo the same thing. But thank you everybody for joining, and we really appreciate the opportunity to share some of our thoughts.
Yeah, well, very much appreciate you, Matt and Danielle, for being here. Just a reminder to everyone, I'll send out a link to the recording of this after. I'll also send out a couple actually really great resources Matt and Danielle have put together, and then a way to contact both of them. So if you do want to reach out with any evaluation questions, or you need a great audit partner, I'll have their contact in the follow-up. And then, thank you everyone so much. Appreciate you both, and we'll see you next time.
All right. Thanks, Emma.
All right.
Great to see you.
Thanks, everybody.
Okay. Bye-bye.